Hello Internet! Today is Friday, and that means it is time for my weekly update. And it has been quite a week, as you might have noticed. Alright, let's jump into it. Okay, so the selling has been more aggressive this week than it has been before that. We're now in second or third week of selling across the NASDAQ, which has driven other indexes down. I think in the past few days, the panic has spread to other sectors. So if we take a look at this is a pretty good way to get a view for what's losing and what's winning on any particular day. We can see it's more or less red across the board except for energy. And this is in part because oil prices had a nice little run today yesterday for several reasons. So it looks like the whole market has just taken a huge hammering, and I guess it has, for a day or two. But if we look back a little further, we can see patterns starting to emerge. And if we jump back to about a month, and that's kind of when the selling started, maybe 3 weeks, we can see that there's a pattern across when it comes to which sectors are losing the most and which sectors are winning the most. So we can see the rotation that you hear everyone talking about. Rotation. It's getting quite boring to hear about it, I agree, but we're in the midst of it. Although it has accelerated and caused panic across the market. And so this is why we see the likes of just about everything down yesterday. This has hit certain companies harder than others, and it's usually the companies with the higher valuations. So if we jump to the 1 month view, we can see these are the companies that have lost, double-digit numbers and, approaching fairly high double-digit percentages. And that's because some of these companies were commanding very high valuations. Not Canadian Solar so much, but I think Canadian Solar has sold off because solar in general has sold off. And solar in general has had a very good run up until recently. Again, if you've got a long-term kind of view, I don't think this matters too much. Personally, I wouldn't invest in NIO, for example, long-term, just because the valuation is still high. But a lot of these other companies are still very good companies. And so they will come back. It's just going to be a matter of time. On the flip side, I have been buying certain UK and stocks and other geographies and sectors to offset the rotation when it arrived. And these have been performing quite well. So you can see the 1 month return for lots of these UK and European stocks doing fantastically, which I've been happy about, because my job is to reduce the blows of these corrections when they arrive, and the NASDAQ is technically in a correction now. So I need to cushion those blows to the portfolio when they arrive. If I can make a little bit of money, that's fine, but there's a lot of damage control going on too. And then ultimately, I'm trying to beat the market on the way down, which means losing less than the market loses on the way down, and then making more than the market when it rises. And so far, so good. I'll talk about stats in a minute. All right. So in terms of my stats, by the way, this is wrong. It hasn't caught up. So this number will be when the stats do update later today. I think it'll be about roughly minus 1.2. So it'll be the first red in a month for a while. It's not such a big thing. First of all, we're not through the whole month just yet. But even if the month ended up being red, some months are red. That's the way it goes. Quite interestingly, cryptos have taken a bit of a slide too, but not nearly as much as I would have expected. So this is quite interesting. I think there's just too much good stuff happening around, for example, the likes of Bitcoin right now, for it to take too much of a hammering. And so it's held its own remarkably well, and I think this is quite a bullish sign. Just to give you a bit of food for thought, I also wanted to look at the NASDAQ historical chart. So I've gone back nearly 10 years, and just so you know, is this the logarithmic scale? I'm going to turn logarithmic. I'll leave it on for now. So this is the percentage drop that we have seen recently, and this has a lot of people terrified because the bull run has been good, and there are lots of new retail investors in the market. So I understand this. If this is your first rodeo, this kind of thing can be scary. But just note that, you know, this has happened before. And this has happened before. Maybe not to this degree, because this was February and March last year, but it's happened before. You know, this is not something new in the market at all. These kinds of sell-offs happen all the time. All the time. And while you're going through them, they're annoying, right? And they can be a little bit stressful, especially if you're fairly new to the market. But they also provide opportunity. So I think in February and March last year, my portfolio was down quite a lot. I think at one point it was down double digits. But that meant I was able to position the portfolio for what came next. That fantastic bull rally. And that's the idea, really. Most people lose money in the market because they panic and they sell on these big drops, when in fact you should be doing quite a lot of the opposite. All right, so the reason the markets have slid is because of rising bond yields. I need to do a video on bonds and explain how they work. But looking at the 10-year bond yield, this is one of the terms, yield terms, that the market is very interested in. And yesterday, the Fed chair, Mr. Powell, he was interviewed, and as he was interviewed, the bond yield spiked massively. These big spikes are all in such a short time frame are very unusual. And this was because the market was hoping that Powell would say something to the likes of, I will be buying long-term bonds, and buying bonds can drive their price down, drive their prices up, because demand for them is increasing, and bond yields have an inverse relationship to prices. So as prices go up, bond yields go down, and the market feels a little bit happier because high bond yields usually signal high upcoming inflation, and if inflation happens, the central banks of countries usually raise the interest rates. Raising the interest rates increases the cost of taking on debt, and that means that fewer people and fewer companies will take on debt, and without debt, companies grow more slowly. And if they grow more slowly, then the very high prices that we've awarded companies in the stock market seem a little bit more likely to be fair, because earnings will drop. That was a very quick explanation of the mechanics. I'll try to do a more detailed video in the upcoming weeks. The long and short of this, though, is that I've been sticking very close to the story about bonds, and there is a very strong feeling that what we're seeing reflected in bond rates is probably because of what they're calling plumbing. So a whole bunch of things that happened all at once in the bond market that have pushed yields up, and then have caused panic, which means people sell the bonds, pushing yields up even more. So the feeling amongst professionals, people that know bonds much better than I, is that bond rates should stabilize, and this isn't as big an issue as the market is making it out to be for now. It might be an issue a few years down the line, but for now, the market is overreacting. It's triggered a sell-off. You know, these things happen. All right. European and Asian markets have caught a little bit of the panic that we've seen in the US, and this has meant that they have obviously tumbled. This is a bit strange. Well, it's not so strange because the other indexes do tend to copycat the US, but it's silly. It's a very silly move. The UK market is likely, and Asia is likely to have much lower inflation than the US because of a few reasons. So they're a bit more insulated from the knock-on effect of yield rises and inflation. Also, the UK and the EU economies are likely to pick up a lot through this year, as is the US economy. And China and Asia are already doing pretty well. So I'm trying not to be too dismissive of the sell-off and the whole bond saga, because it does signal a potential problem in the distant future. But for now, the market is overreacting. It'll be fine. When will the selling stop? I've got no idea. I can't tell you that. No one can. If anyone is telling you that they know exactly when the sell-off's going to stop, they're charlatans. Don't believe them. But what I do know is that a lot of companies that were very expensive not too long ago are looking fairly priced. And this is interesting because the professional investors they'll have a set of stocks that they've been interested in for a while. They'll have their lists that they've wanted to buy from, and things would have been too expensive, and now things are coming down, stocks are coming down in terms of price, and they'll be itching to get in. And one of the key concerns they'll have is that if the market realizes that these stocks are cheap before they get in, the prices are going to rise. And as time goes on and stock prices drop, this is going to make investors more and more keen to buy those stocks, which would put a bottom in the market and ultimately see a rise from then on out. So I think we're close to that kind of a thing happening, if it isn't happening already. I also wanted to just quickly show something interesting, if a little bit scary. So the S&P 500 has been trading in a channel for a long time, and we've just popped out the bottom of that channel. And we're also under the, is it the 50? Slow moving average, which is a bearish signal. So yeah, we need to keep an eye on that. And I earlier said the Nasdaq is officially in a bear market. So sorry, in a correction. A correction is when an index makes a move of more than 10% to the downside from the recent all-time high, and the Nasdaq is now at minus 11%. So we'll have to see if it sits around here. If it doesn't, then I don't think it'll be considered a correction. But if it does stay in this kind of range for a while, then yes, we're in correction territory, and corrections tend to take a few weeks to a couple months to recover. All right, what the market isn't talking about is there's some very interesting action in the Chinese markets. Everyone's focused on the US at the moment. There are liquidity issues that are rearing their head in very strange little ways around the Chinese market. And so my Chinese stocks have taken a hammering in the past week or so. And this drove a lot of the negative return in my stocks yesterday, which is annoying, but I'm not too worried because I think China's going to see massive strength through the coming years and decades. And a lot of my Chinese stocks, tech stocks, are incredibly well priced, and there are companies that are very promising. So I think we'll see some explosive growth there, but just don't know exactly when. Something that's also interesting is that the UK is busy fighting to retain its crown as the financial capital of Europe. After Brexit, we've lost a lot, and so there's some interesting developments around how we handle IPOs. A lot of our biggest tech companies are looking to the US to kind of fund them, because the US market is very friendly to startups and when it comes to finding investment. So Delivery is going to IPO. I don't know if it's an IPO or direct listing. And it looks as though we're going to see some legislative changes around going public in the next weeks, months, and quarters in the UK. This will be very interesting. It looks as though our government is going to try and make it more attractive for our companies to list. So keep an eye on that. In terms of the coming week, so it's all been about bond yields and inflation and rotations for the past few weeks. But there is this backdrop of the stimulus package finally, eventually, making it through the US government and into the hands of the US citizens. So this will become a focus, I think, of the headlines in the coming weeks. When this happens, I would expect a bit of bullish movement. I'm not sure to what degree it's been priced in, but given the recent sell-off, we could see this help spur a bit more bullish action. I also wanted to say we have seen recovery stocks. So when I say recovery stocks, I mean the likes of travel companies, airlines, insurance companies, etc. We've seen them be quite resilient to the selling initially. So I showed you the 1 month return here. So initially they were fairly resilient and money was pouring into those areas. But as we have seen from the past week, the selling was a little bit more, and in particular yesterday, the selling was a bit more indiscriminate. This gives us another opportunity to buy into these stocks. I think some of these stocks are already turning just on the day, just today. Some of these were negative. So these recovery stocks, they've sold off recently in sympathy with the wider market. But up until that, they were rallying very strongly. They're taking a bit of a breather now because they have gained a lot in a short amount of time, but also because I think there was widespread panic. But we are now being given another opportunity to get in before this rally continues. And I suspect this rally will continue and for a long time. So I am optimistic. I know that it's been frustrating going through the past few weeks, but you know, the market doesn't only go up. And if it was easy to make money in the market, everyone would be doing it, not just 25% of people. All right, so on a grand scale, we're still up for the year. That's great. I expect the year to be bullish overall. GDP around the world is going to continue to grow. Try not to worry about it too much, because it will come back. And the more every day that we go through a bit more of the consolidation is a day we get closer to the inevitable next bull run. All right, thank you very much. Have a great weekend, and I'll talk to you next week. Bye.